everybody. I want to welcome you again to this week's podcast, The Real Estate Rundown. Today I'm Robert Green, and this is
Trey Wilkinson.
we see a lot of questions that involve what does it look like to get into investing, real estate investing, all the ups and downs and things like that. So we just want to bring some questions and get some expertise and answer from somebody who knows the ins and outs of it. So today, so the question is how does an investor begin to diversify their portfolio? This is speaking to someone who's kind of been in the game and has a few, and how do they begin to diversify?
Sure. Well, there's a couple different ways you could think about diversifying your portfolio. If you've got, say some single family rentals, you could look outside that into multifamily or commercial. I prefer single family, so you can diversify your portfolio with just adding other single family, and what that will allow you to do, even adding other properties, is if you have vacancy or you have unexpected repairs or something like that. If you have 10 versus 3 or 15 versus 5 or 7 or 8, then that allows you to offset some of those unexpected expenses or out of the ordinary expenses that you might have through vacancy or larger repairs or something like that, or a roof that you need to replace. So I would say, you can diversify many ways. My personal favorite is just adding to the portfolio, because at that point it averages over a larger number versus a smaller number.
Very interesting. So the big one, flipping houses versus long-term rental, which is better and why?
Well, you can certainly make money doing both. I'll tell you kind of what happened to me is I probably started flipping before I started having long-term rentals. What I found was the first 2 or 3 I did, I maybe made $5, $8, $10, $12,000, and I chased my tail for a few months, and I was like, man, I really think I should have made more money than I did. Once I finally got all my costs in and figured out what I netted after I left the title company, I said, if I made $8,000 or $10,000 on this, I probably could have made that every single year if I'd held on to the house or more.
Sure.
So I started kind of holding on to them at that point. And I said, I'd rather make it every year than just one shot. Then I got to go look for the next one, look for the next one. So I've definitely done both. They definitely both work. I have shifted much more towards long-term rentals myself, just because that income keeps clicking every month, and you don't think about it, but that price appreciation really helps you over time.
That makes sense. It's eliminating the chasing the deal feel. It's kind of more of a status quo, and everything stays the same rather than having to constantly chase yourself.
Sure, I'm not having to go to the next deal because I look forward to that rental income that's coming in every month. Definitely got to save up for the unexpected, because it will happen. But
Sure.
Right now, I would say my preference is long-term holds.
Sure. You kind of touched on that when you answered that question, talking about the year after year income. How does an investor calculate their return on investment? As far as, is there a special number to aim for? When you buy the house, to rent values, things like that.
Sure. I want to, when I'm looking at a deal, whether I'm going to buy it or not, is at the end of after I get it all fixed up and ready to rent, and once it's stabilized, I want a double-digit return. Obviously the higher the better, but if I don't really want to jump through all those hoops and go to all the trouble if I'm not getting the return I need to make it comfortable and make it work. Also, I want to build in some contingency there because, again, things pop up and things happen.
Sure.
So I want to make 10% on my investment at least, but ideally I shoot higher than that on a cash flow basis. But you got to factor in a lot of other things because just if you're going to rent a property, say for $1,000, just to make the math easy, and that's $12,000 a year, well, you're going to have to pay those real estate taxes every year, and they're going to creep up more than likely. Mm-hmm. You're going to have to pay that insurance every year, every month, however you break it down, and that's probably going to increase over time. And you definitely are going to have repairs and maintenance. People don't factor that in, but you're going to have it. Sure. You're also going to have, vacancy and turnover and collections and other items. So you want to build in a kind of a contingency. You want to be kind of conservative, especially with those expense numbers, because that you will over time be able to bump that rent, but those expenses are more variable than that rent rate income that you typically get. So I tell all investors, I said, you really want to factor in all of those costs and make sure you have enough money left over each month to make it comfortable for you. And you also want to kind of, with that extra money, kind of build yourself a reserve best you can.
Sure. You kind of mentioned on the cash flow thing and the repairs that creep up that are unexpected. Is it often that you see investors get in over their heads that don't factor those things in? And what are some things avenues that investors can have an exit plan? Obviously any business you want to do, you need to have an exit plan of some sort. Is that such a thing in investments?
Sure, and it happens, and sometimes a deal just turns out not to be as good as you thought it was. And the key to that is when you're buying an investment property, you want to be comfortable where you're buying it. You don't make your money when you're selling the property. You make your money when you buy it. So if you get in there and you get a bad tenant and you say, I don't like this, or this property's, I'm chasing this down every month or chasing that down every month, you want to be in a position where if you needed to, you could sell the property and you have plenty of room where you can get all your money back plus, some good cushion in there. I mean, every property I buy is at a discount. So sure. That's just the way I operate. So when I go to market, I can sell it at full retail, or if I don't want to get it in the condition it needs to be for full retail, I could comfortably sell it and still have enough room to get out of the property if it just didn't work out the way I thought it should have.
Sure. Well, that's all great information. Wanted to thank you for coming by and sharing some expertise in the investment world. I know it's a kind of a dark hole for a lot of people who don't have the education or the direction about it. And so sharing some of your experiences and working through this, I appreciate you coming by and sharing.
Sure. Thanks for having me, Robert.
Awesome. Thanks.